Now let's talk about the fraud risk factors. Like what are the risks that are associated with respect to the fraud? Like the auditors should take an approach where he should identify the fraud risk factors in a company. So what is the identification he will do in terms of the fraud risk? To identify the frauds that could potentially happen in a company, you need to think of MOD, MOD. MOD is motive, opportunity, dishonesty. MOD is motive, opportunity and dishonesty. Motive is where you have an incentive or pressure to commit the fraud. Opportunity is where you have a perceived opportunity to commit the fraud. And dishonesty is where you have an ability or attitude to rationalize the fraudulent action. That is called as dishonesty. So motive is where you are having a incentive, or you are interested to do a fraud, or you are under pressure to do the fraud. Opportunity is where you have an opportunity, like, it's like the doors of a house is kept open. So definitely someone will come in and take away your things, right? So there is an opportunity for the criminal to conduct a fraud is where we call it as a perceived opportunity. Ability or attitude to rationalize the fraudulent action, like, he's like having a criminal mindset. He is a dishonest person. Like even if he commits a fraud, he does not accept it as a mistake, but rather saying that there are reasons for me to commit the fraud. So as we said, the frauds are in financial statement are of two categories. One is fraudulent financial reporting, where the businesses actually report falsified information. Second is misappropriation of assets. So when it comes to the fraudulent financial reporting, let's divide the factors into three categories: motive, opportunity and dishonesty. In terms of motive, or where the incentive or pressure is, the financial stability or profitability is threatened. Like very recently, what is happening here is the startup ecosystem. Every company wants to grow, become a unicorn, or they want to be like a big organization and go to make it 1,000 crores, 2,000 crores revenue. But definitely every company will not do better or do good on a long period of time. It will take some time for them to come out, but every single time they will not do good. Like they will have some ups and downs. So when they want to take funding, when they want an investment from their stakeholders or the shareholders, they falsify the information. They make it, in a wrong way, report the revenues more or expenses less and profits more, because they are threatened about the profitability. If they become a loss, whether will I get investments, whether my investors will start questioning me. Because of threatening, they do that. There was a company in India very recently, I think in last year, if I'm not wrong, it was Go Mechanic, if I'm not wrong. I think it was Go Mechanic. Let me think. Yes, I think yes. Yep, it was Go Mechanic. So there is a company called as Go Mechanic, which was a startup. And this startup company, right, what did they do is they showed the revenues and as overstated and expenses as understated, so that their profits will be high. Now that is was discovered, and the company had to be wind down, right? So that is called as an example of motive or pressure, because they are highly pressured or grilled from their investors. They somehow wants to hide certain factors and say that even if they are bleeding, they want to say it as everything is good. Pressure on management to meet the expectations of the third parties. Like they have stakeholders or shareholders, and they want to meet their expectations. So definitely there is a pressure from their side. Personal finance situation of the management is threatened by the entity's financial performance. So if the entity is not financially doing well, the company is having losses, what happens to management? Management will also lose money, because they will not get salaries, they will not get bonuses, etc. So to ensure that they get their bonus or salaries, they will start doing, misappropriate the financial statements. Excessive pressure on management or operating personnel to meet financial targets, like salesmen. It's a very classic example, it's a sales commission. Just they want to show that commission as high, they want the employees want to take up the high commission, they will show the sales as high. Now that is definitely an incentive or a pressure. They want to meet the target, so they will show the sales as high. The second one is opportunities. They can do these through significant related party transaction. Like if financial stability has to be threatened, what they will do is another company will be making money. They will take the money from there and put it in this company, and doing certain significant related party transactions, you will show as if the fund, revenue or expenses are high or low. To give you a simple example, let us say that there is a company and the company is not doing well in terms of revenue. Now, the same director of the company have another company, a parent company, or let's say a sister concern. Now that sister concern will give orders to this company which is not doing good. So there is an intercompany transaction, and when they are giving the orders, they will give it in a high profit basis. Like revenue will be overcharged. Still they will give the orders. So that is misappropriation, right? It's not done in an arm's length basis. So that is definitely a misappropriation. Assets, liabilities, or revenues are based on significant estimates. You put, assets or liabilities, everything on an estimation basis, and show the assets. Like in prudence, there is a concept that until your assets or income have been recognized, you cannot show the asset or income. You're virtually certain that you will receive the income, you cannot show the income. But what you will do, you will expect that, okay, you know what, we are going to receive it, so we will show the asset or revenue. Domination of management by a single person. So this is what we learned in corporate governance. Like very small people are dominating the company. Enron scandal, Polypec, all are examples of the opportunity. Complex or unstable organization structure. If the company does not have strong structure or internal control system, it leaves opportunities for the employees to commit some fraudulent activity. Internal control are weak internal controls. If there is a gold jewelry item that is kept in a jewelry shop and the CCTV camera and the alarms are not working, definitely there will be one person who might do some stealing and take away all the items. Attitudes and rationalization. This is the dishonesty, right? So ineffective communication of enforcement of the entity's values or ethical standards by the management. Like management are not having strong honest among them. Like they are not doing something which is very deeply honesty aspect. Like they do not say, oh, you know what, this is wrong, this is right, etc. That particular enforcement they are not doing. Known history of violations of securities laws and orders and other regulations. Like the management or the company have had previous experiences of doing violations of laws and regulations, etc. A practice by management of committing to achieve aggressive or unrealistic forecast. They keep high forecast thinking that they will achieve it, but they will fall short. Low morale among the senior management. Like the management is not, the company is not doing well, and there is no support from the shareholders, there is no support from the directors, so definitely management will be very low on morale. Relationship between management and the current or the predecessor auditor is strained. So the management and the auditor is having a bad relationship. Definitely it shows the attitudes of a fraudulent basis. Like because the auditor is there to detect certain kind of frauds that could happen, right? So management will be going very hard on them. They'll be like going against on certain aspects. So that's what the fraudulent financial reporting talks about. Now when it comes to misappropriation of assets, this is much more easier to identify. The motive, opportunity and dishonesty are much more easier. When it comes to motive, definitely personal financial obligations. There was a fraud that was discovered in Goldman when I was working there. Is that there was a VP, was a vice president. He was, tangled with some online gambling game and had a huge loss. Like he had a huge gambling loss and he had lost lot of money, and he started taking loans and investing in the gambling game and started losing further money. So he had around 20 lakhs of loans. So to recover that, what he did is he did a fraud in Goldman. Like he's a vice president, he would be earning a good amount in the company. What he did is he somehow routed the client's money within the Goldman by talking to the other employees, and they somehow taking away their credentials. He routed certain money from the Goldman's account to his personal account. So here, if you look at the motive, what is the motive? Personal financial obligations. Did he have the opportunity? Yes. The control systems were strong. In fact, they identified him and they were able to arrest him within a matter of 24 hours to 48 hours. But still, how did he manage to do this? The opportunity was that, he's seeing transactions or the client transactions on a daily basis. And he saw a weak control where, a slighter weaker control where if with two people's credentials, he can easily reroute the funds. So he saw the opportunity and he took it. And this is his personal behavior. This is how, he tries to act upon it, right? So that's how the, frauds happen, right? Like first indication is that first motive is to have a personal obligation. Like they are personally interested to do certain frauds because they are stranded on certain financial obligations. Second is that there could be adverse relationship between the entity and the employees with access to the cash or other assets susceptible to the theft. The employees are not getting paid well, but the company is doing huge profits. They are not giving good salaries, good bonus. Definitely, there could be a pressure on the employee side to somehow I need to take my money that I have hard worked, etc. Opportunities are where there is a weak controls, like large amount of cash is kept and cash on hand and it is not banked. Like let's say retail business on a store, you get like 1,000 customers on a daily basis and they give you cash dealings and large cash on hand you have, and at the end of the day it's not gone and deposited into the bank, or you don't even keep it inside a safe locker. That itself is a big risk. Inventory items that are small in size are high value or high in demand. So inventory items are small inventory items but with high value and small items. Like for example, a diamond ring. One diamond ring could be somehow between the range of 30 to 40,000 to 1 lakh to even 2 lakh, 3 lakh. But it's a small item. Even if you put it in a pocket or you put it inside, in your clothes, it's very difficult to identify, right? So that's a very high risk item. That's why if you go to a jewelry shop, every single day, morning and evening, all the inventories are being counted. Every single day, the security systems and cameras everything are checked. Even now, when you go to retail shops like clothing shops, they have that magnet thing that is attached to the clothes, right? The magnet that is attached to the clothes, and when someone tries to steal away that thing, the cloth, the alarm goes off. And there could be cases where the assets are kept in an easily convertible bond, assets like bearer bonds, diamonds, or computer chips, which can be easily converted to cash. Inadequate internal controls is a classic example of opportunity for the employees. Like even though you feel, you think that your employees are like godly, they are pure in heart and you highly value them, definitely the controls could be weaker, which could lead to such issues. The next part is attitudes or rationalization. Attitude is deliberate overriding of the existing controls. Whatever the existing controls are, you're deliberately trying to override them. Failing to correct the known internal control deficiencies. If you've identified internal control deficiencies, you're not correcting them. Rather, you're going ahead and doing it again and again. Behavior indicating displeasure or dissatisfaction with the entity. Like you're not satisfied with the entity, the company is not satisfied with the entity and they are having huge amount of displeasure or dissatisfaction. Changes in behavior or lifestyle, like you want to change the behavior or your lifestyle, which will also indicate the in respect of the misappropriation of these assets. So as per ISA 330, which we are going to learn in chapter 6 in detail, but however, the auditor shall determine the overall responses when there is a risk of material misstatement due to fraud. So as I told you, the prevention of fraud is with the management. Auditor is not and should not be responsible for prevention. He should be responsible only for detection. And detection as such, he is not going to do specific procedure to detect the fraud. He's going to do his normal audit, and by the light of it, he might identify fraud. But fraud risk should be documented. He needs to think in a perspective that there could be a potential fraud, and he needs to create procedures which will help him to identify or detect certain fraud. But for that, he doesn't have to take up a separate services altogether and sit and start looking into fraud only. Not required. So the responses that he might create is number one, consider the assignment and supervision of personnel. First, identify the assignment, what they are doing, what are their nature of the business, and create a supervision of personnel, like create a team. Okay, so that's the overall approach. Like you need to consider firstly the overall audit approach, what you're going to do. Look at the client and segregate or assign a team which is superior enough if there is a fraud risk that could incur. So don't go and appoint a team for a company which is having a high risk client. Employ a team which are having certain kind of experiences, or even managers who are having enough experiences to do an audit of a certain client. Consider the selection and application of accounting policies used by the entity. Whatever the policies or procedures they have to use should be considered. Third is incorporate an element of unpredictability. Right? Whatever the procedures you're going to select, you need to incorporate an unpredictability. Don't let the opposite person predict what's going to happen. If you do that, definitely you will face something wrong. So, similar to that, the auditor may have to amend the nature and extent of the planned audit procedures due to fraud at an assertion level. So, we are going to learn something called as assertions, which are characteristics of the financial statement, which we will learn it in later. But we need to characterize or segregate certain nature, timing or extent of the procedures, which will help us to identify the risk potential due to the fraud aspect. To give you an example, revenue recognition. Revenue recognition should always be considered to be a significant risk. Why? Because that's where the management's biggest motive is. That's where his biggest opportunity is. That's where he is trying to be dishonest. When it comes to revenue, it's the easiest way he can overcharge his revenue, because it's all with him. He's only creating a revenue, so he can create falsified invoices. He can, the revenue might not be recognized until tomorrow, but he will show it as if today he has received the money. It's also false. So revenue recognition is always considered to be a significant risk. And in fact, sometimes if it is cash related, manual related revenues, then it is considered as a fraud risk as well. If not, it has to be clearly documented why a revenue is not a significant risk. Right. So such cases where you are going to sit and identify the risk associated to the material misstatement and what are the procedures you're going to employ with respect to the material misstatement. In addition, the auditor should also consider the following. What are the audit procedures he will be inculcating with respect to management override of controls? If there is a management override of controls, what are the responses he's going to do? Journal entries and other adjustments. So when it comes to journal entries might be posted by the management, right? Sorry, not by the management, but not by the system. Sometimes there are automated journal entries which get automatically posted in the system. But there are other cases, journal entries where it is not posted by the system, but manually by people. Now, due to this factor, what happens is that because of this journal entry, and other related item adjustments, it is required that the auditor will scrutinize or investigate the journal entries. Why? Because the journal entry could indicate something wrong. They would have posted an entry where they have received the revenue, but technically could have been a deferred revenue. So investigation of the journal entries could identify, because it is the primary source of entry into the books of transactions. The transaction is entering into the books firstly through the journal entry. So that's where the first mistake would happen. Accounting estimates. Look at or detail and do an analysis of accounting estimates. Why? Because accounting estimates can be misappropriated. So it's an estimation. They will reduce the provisions saying that, oh, you know what, we don't expect it to be, without any rationale. Significant transactions. We need to know what are the significant transactions that have come in. What if the company is suddenly getting a $1 million? What is the purpose? Why you are getting it? From where you got it? What is the rationale? All those factors should also auditor consider. And when it comes to certain procedures, what he needs to do? Firstly, the auditor evaluates the audit evidence to obtain to ensure it's consistent and that it achieves aim of answering the risk of fraud. He needs to evaluate the evidence that is obtained. Second, written representations. He need to obtain written representations from the management that they accept its responsibility in relation to prevention and detection of fraud and the relevant disclosures. However, when there is a misstatement indicating a fraud, the auditor should consider its implications. The auditor must also document significant decisions reached as a result of team's discussion of fraud. Like they have to discuss what are the indications of the fraud, so that have to be documented. Like when there is a fraud risk, we discuss it with the team, we discuss it with the management, we discuss it with those charged with governance, we discuss with employee members, personnel, etc. So, and whatever we discuss have to be documented. Identify and assess the risk of material misstatement due to fraud. Sit down, look at all the processes of the company, go through all the systems and check where there could be a case of a fraud. The easiest way there could be case of fraud is where the internal controls are deficient. Second, when there is too much of manual interventions. If there is too much of manual interventions where there is a human interventions on those areas, there isn't chances of fraud. Overall responses to the assessed risk. Results of specific audit test. Any communication with the management. So review whatever the responses that you have creating. Like if you are identifying, okay, revenue, there is a chance of a risk. What are the procedures you want to implement? If you have conducted certain audits, what are the tests, specific audit tests that is you have got as a result? And with the management, any communications that you have achieved from the management, what are the responses in relation to the communications from the management should also be checked. How are you going to communicate to the management? What are you going to do? How are you going to talk to? What all questions you're going to ask? All those things you can as well check. And when it comes to the communication, as I told you, this we have already discussed, but again, I'm going to repeat it. The communication that we're going to do are of three things. One is that we're going to communicate it with the management. We are going to communicate with those charged with governance. We're going to communicate with employees who have significant roles on internal controls, and others where the fraud results in a material misstatement in the financial statement. So when it comes to fraud, or when the auditor identifies a fraud or he's suspecting a fraud, he needs to communicate to the immediately to the management, like ask to the management, what are the cases of fraud happening? Has there been any fraud in previously? He needs to communicate to those charged with governance, as well as he needs to communicate with others employees who are part of the internal controls and others who feel that there is a fraudulent transactions that could happen. Further, when it comes to fraud, the auditor have a statutory duty to report to the regulators. Like if there is a fraud that have been detected and the fraud have been identified, then auditors should report it to the regulator. Right? But if it is breaching their professional duty of confidence, then definitely you can consider a legal advice. Okay? But in certain statutory cases, there is no such duty as such. But if you want to report it, let's say for example, a company is doing clear case fraud and they're gonna have a doomsday any point in time, and even though it's not from the statutory duty but from auditors' public interest duty, they can report it. Now, when there is fraud, and how will it impact the auditor report? Let us say there is a fraud. Now, when there is fraud, you definitely have to report it to the financial statement. You need to mention it as a disclosure in the financial statement. the fraud, the loss of assets or loss of income due to fraud have to be rectified or shown in the financial statement and make necessary adjustments. If that is not corrected, then you might issue qualified or adverse opinion. But you are suspecting a fraud, and for certain transactions the client is not giving you evidence, then it is insufficient or inappropriate evidence, where you will issue qualified or disclaimer of opinion. And even then you are unable to move and you're having major issues, definitely you can do a withdrawal. Like money laundering issues are there, you can do ensure that you report it to the regulators. But however, consider, before you withdraw, consider the factor of confidentiality and tipping off issues. Okay, so the auditor should consider whether we should withdraw from it if they uncover exceptional circumstances, like they cannot go further, then they have to be done. So this is what an auditor should do when it comes to a fraud or when he is suspecting a fraud related items in the